Zero. Becky, thank you so much for today. And we're going to be joining you next week with some more great, big, beautiful bill information. Good morning, ladies and gentlemen. This is Dereck Blair. I'm president, founder of Caprock Financial Group here in Lubbock, Texas. And this is Caprock Wealth and Wellness. This is the Caprock Blueprint to a richer, more balanced life. Our phone number here at the office is 806-749-7870. And I am super excited about today because last week we had one of my favorite people on, and she agreed to come back on today and join us. And we're going to talk more about the big, beautiful bill. A lot of misconceptions going on with that, a lot of great information. We're diving into it. And Becky in Stonewood, her company, she's the CEO of Stonewood. She is on the forefront of understanding this bill, of knowing how it works. And so when it comes to things like that, we absolutely lean on her to just learn the information, get as much advice as we can from her. And so we're super excited. We're blessed to have her on today. Good morning, Becky. How are you doing?
Good morning. I'm doing great. Always love talking government, taxes, the fiscal state of our country.
Everybody's favorite subject.
Yeah.
Lots of good information. So last week, we ended the show talking about Medicare, and Medicare is just so important. There's a lot of misunderstandings. And there's something that you brought up last week that I really want to touch on again, because we had a lot of questions this week about this, not understanding it. And I really want to dive into it. It's the IRMAA tax. And a lot of people don't understand when it comes to Medicare, you're having a tax on it again. And so if you don't mind, let's spend a few minutes talking about IRMAA and break down of how this works for our clients.
Yeah. IRMAA is a great example of what I like to say, Congress just gets creative. So, a few years ago, Congress realized that the Medicare program needed more money. Well, did they want to go raise taxes through changing tax bracket rates? They could. But then someone had the great idea, hold on, what if we just kind of created a new tax specifically to help fund some of these Medicare trust funds? And they came up with IRMAA. Now, IRMAA stands for the Income Related Monthly Adjustment Amount. And it is an additional fee that American savers may pay on top of their Medicare Part B and Part D premiums, depending on their income level. So essentially what they said is, okay, you're going to pay your Medicare premiums for your Part B and Part D. And if you meet certain income thresholds, we're going to have another fee you pay on top of that called IRMAA. So what this has done is created another stream of revenue for the government without the government having to really say, oh, look, we're changing your tax bracket rates. And I'll tell you, it's significant. My parents who are on Medicare, between their Medicare premiums and their IRMAA payments, they pay more for each month for their Medicare than I pay for my private insurance. So these fees can be substantial for savers. Now, Medicare is still a great program, good insurance, but it is not the free government health care that many seniors are kind of led to believe. And especially because of IRMAA for higher income earners, it really is driving their overall cost up. Now, here's where I think IRMAA is a little bit interesting. I need to go back and look at the floor debate when they passed this provision. IRMAA fees are calculated on a separate modified adjusted gross income than the IRS uses for your taxes. And in calculating the IRMAA fee, the government does not consider Roth income or other tax-free income streams. So one of the reasons why I think, and we were talking about this last week, Roth conversions continue to be so important, is the more of our income that we can generate from tax-free vehicles in the future, the less income we'll have that is applied towards those IRMAA tables. So it makes it more likely that we could either have lower IRMAA fees or eliminate our IRMAA fees altogether. It's kind of an odd quirk of the legislation, but right now, tax diversification doesn't just help us with taxes, it can also help us offset these IRMAA fees.
Wow. So your silent partner that's going to be able to dip into your retirement 401ks, 403bs, IRAs. Yeah. I found another way to dip into your pocket again if you're not handling your money correctly when you're taking the money. Maybe you're taking it the best you can, but you haven't been efficient as possible. So they're going to find another way to get some more money out of you.
Yeah. And I think that IRMAA, besides impacting a lot of savers, I was surprised, my parents had never really heard of IRMAA until they elected, their Medicare benefits and suddenly got hit with this big surprise fee. I think it is the wave of the future. We talked a little last week about all the different ways Congress can generate more revenue for the country. The government can generate it through changing tax bracket rates, so raising bracket rates. It can also generate it by applying more income to each bracket rate. So if the bracket currently hits at $100,000 of income, but they lower that threshold to $80,000 of income, now more of your income is being taxed at the higher bracket. So we've got brackets, we've got income applied to brackets, we have changes in the structure of taxation, what is taxed, when it's taxed, how it's taxed, who it's taxed for. We see that a lot with like the estate tax exemptions or with other kind of deductions that Congress can put on or take away. And the fourth way is just they come up with new taxes and new fees that you have to pay. So I feel like our head's always on a swivel. We really got to watch a lot of different directions where the government will likely be looking to generate additional revenue in the years ahead.
Man, that's crazy. So one of the things that we talk about a lot in our seminars are the rules of retirement have changed. It's just so different now because we have to take care of ourselves. It's no longer employee driven, it's employer driven. We have to look out. And used to, when we talk a lot about it, it was market risk. When I would go to retire, I worried about the market. That was my main concern. But nowadays we have to worry about the market. We have to worry about inflation. We have to worry about tax risk. And we have to worry about legislation risk, about what you just talked about. The legislators can change on a dime. Every 2 to 4 years when somebody's running for a campaign, they're making all these promises about what we're going to do and what's going to happen. We're $36 trillion in debt, Becky. Some way we got to pay this. And you just had a perfect example of how do we start to come up with these kind of funds. And if we have someone on a fixed budget and they're not aware of these IRMAA taxes, and this is going to cost them hundreds and hundreds of dollars, that's a car payment. That's a grocery bill. That changes their lifestyle drastically.
Yeah. And we have this habit, I think, as American savers to think, elections can solve some of these problems for us. If a certain party is in control in Washington, things will be better. If another party is in control, things might be worse. And that is true in the short term. But what I think is important for savers to realize is that the number one thing driving tax and legislative risk in retirement is not actually who's in the White House and who controls the House and Senate. The number one thing that drives that risk is the fact that in America, we have elections every 2 years. And that means every 2 years, we have new government. So anything that is done today can be undone in the future. Anything that is undone today can be redone in the future. We're just in this constant cycle of change. And when it comes to taxes and retirement, that means probably 10 to 15 election cycles for most of our listeners today. There's no way to predict what the tax environment is going to be 10 election cycles from now. We could barely predict what it might be 2 election cycles from now. What that means is that just like other risks, we have to diversify to protect against it. So I don't know if the market is going to be up or down for the next 10 years. But I have diversified my assets to make sure maybe I have a mix of equities and fixed income so that no matter what happens in the market, I have some protection. It's the exact same thing with taxes. We can't know for certain where taxes will be in a given year, 10, 20, 30 years from now in retirement. But what we can do today is diversify the tax status of our retirement assets to make sure that we have some protection, some hedge against this risk of rising taxes.
Yes, ma'am. Yes, ma'am. Great point. If you have any questions on this, our phone number is 806-749-7870. If you have any questions for Becky, just email us. It's Dereck, D-E-R-E-C-K, at caprockfinancialgroup.com. I'd like to touch on estate taxes, but before we do, I want to introduce these 2 books that we talked about last week. Number 1, The New Rules of Retirement Savings and the No Compromise Retirement Plan. These are great books. And for our younger listeners, The New Rules is something that I was real excited about because it talks about how to get the IRS out of our pocket at an early time in our life so that when we go to retire, that harvest is tax-free. I always say, do you want to pay tax on the seed or pay taxes on the harvest? I'm a big fan of getting the IRS out of my pocket as fast as possible. So if you'd like to receive one of these books, please reach out to us. We'll get them sent to you. It's a great read. Becky did a really good job of breaking it down to the layman's terms. But I would like to touch on estate tax exemptions. We're getting a lot of questions about that in the big, beautiful bill as far as estate taxes and kind of what the changes are coming in on that. Can we dive into that for a few minutes?
Yeah. So the estate tax exemptions that were raised as part of the Tax Cuts and Jobs Act in 2017, those were set to expire at the end of this year. In the One Big Beautiful Bill, Congress now extended those indefinitely. So those higher exemption rates will now stay on. So if we are savers with large estates or with, kind of something that was really going to make us applicable that estate tax, we can pass a lot more of that on to heirs now under the retained higher exemption. But like we talked about last week with the individual income tax bracket rates, when we say that this legislation made these lower rates permanent, permanent does not mean forever. Permanent just means we don't yet know when they will change, and they have to change by Congress passing another bill. So I do want to say we are very fortunate to extend this lower tax rate environment that many of us find ourselves on. The One Big Beautiful Bill gave us a great opportunity for the foreseeable short-term future to have lower taxes. Over time, if you look at demographics, if you look at our federal debt, if you look at kind of our government spending, taxes are going to rise over time. And so what we have to do is leverage the unique low tax environment of today to pay for those higher taxes or to prepare for those higher taxes so we don't have to pay them in the future. An interesting stat. Last year was the first year in history. Dereck, you mentioned that $36 trillion of federal debt. Last year, the United States spent more money servicing our debt than we spent on the defense of our nation. So if you don't think taxes are going to have to eventually normalize at higher levels to pay off some of this debt, this is not sustainable.
No, not at all. You've seen the numbers. It's not going to work. We have to make some changes somewhere. We've got to make them soon. And that brings us into the long-term fix versus the short-term fix. Yeah. Everybody's worried about the short term. What are we going to do right now? But I'm more worried about 20, 30 years. A lot of my clients are going to live 25 to 35 years in retirement. They're living longer than ever before. We've got to make that money last, but we've got to be aware of the legislation and the tax risk long term.
Yeah, it's funny, when Trump won this most recent election, I heard from a lot of savers who would say like, hey, now that Trump won, what should I do about my retirement strategy? How should it change? And I would kind of joke like, hey, if you only plan to be retired for the next 4 years, let's go in and change everything. But if you plan to be retired for the next 10 or 20, 30, or even 40 years in the future, what's changed is the environment today that we can make decisions in. What hasn't changed is the long-term outlook on taxes. And we mentioned this a little last week, but I want to reiterate it. There are kind of 3 key indicators that we need to watch to know where taxes are going in the future. The first is government spending. Are we paying for the government we have? And we are not. Every year for the past couple of years, our country has run about a $1.5 to $2 trillion deficit a year. Right now, almost every tax dollar the government generates is spent on Medicare, Social Security, Medicaid, and debt service alone. So defense spending, national military spending, roads, bridges, transportation, and infrastructure spending, all of that is deficit spending. But all of that is things we need. So we can see these initiatives like DOGE come in and try to reduce some of the government spending. But the fact of the matter is the number one thing driving the vast majority of every dollar the government spends is simply our aging population. And that's the number 2 factor, which is demographics. We have more Americans age 65 plus now than at any point in the last 100 years. And that means Medicare, Social Security, they are going to have increased revenue needs, not decreased revenue needs. The third indicator is what I call debts and deficits. We mentioned that in last fiscal year, we ran almost a $2 trillion deficit. We have a federal debt of about $36 trillion, the highest it has ever been in history. And on top of that, we have about $75 trillion of unfunded Medicare and Social Security liability through the end of the decade or through the end of the century. When you look at those three factors together, that we're not paying for the government we currently have, that the problem is only going to get worse as America's population ages, and that we currently have no way to stop the growth of our debt and deficits, all of that says taxes are going to rise. So whether Republicans or Democrats are in control in Washington may slow or accelerate the path of rising taxes, no one can eliminate it. We need more revenue.
Yes, ma'am. Yes, ma'am. Very good point. So I want to put you on the spot here a little bit because you just said something about Social Security, and you mentioned it last show that it shows that in 2034 that it's supposed to be reduced. Yeah. What are your personal thoughts, and what are you seeing that how are they going to handle Social Security to make sure this baby boomer generation is going to be okay through retirement?
Yeah, I will say if you are nearing retirement age or already retirement, I don't think Congress is going to cut your Social Security benefit for the obvious reason that what is the single largest, most predictable, most dependable voting bloc in all of America? Americans age 65 plus. Where I think we're going to go over time is one, seeing new fees and taxes like IRMAA that are based on your income. You know, when Social Security was introduced, your Social Security benefit didn't used to be taxable. In the 80s under Reagan, they passed a law to make it taxable up to 50% of the benefit. And in the 90s under Clinton, it was now made to be taxable up to 85% of the benefit, which is where we are today. So what they could do is just say now 100% of your benefit is taxable. So we may see some adjustments there. We could also see for future generations, for younger savers, some means testing, where they take Social Security away from this deferred compensation plan that every American is saving for itself and turning it into more of a means tested plan, more like Medicaid or other government programs. So I do think we're going to probably in the near term see some mix of increased taxes and fees and just additional ways to generate more revenue. What they could also do, you know, right now, the amount of your income that you pay Social Security taxes on is capped. And it's capped because the dollar value of your Social Security benefit is also capped. They could divorce those two factors. So Congress could also start taxing all of your income while only giving you a max capped Social Security benefit in return. So they could kind of divorce that the taxes you pay are somehow related to the benefit you will receive in the future. A lot of different ways that they could make adjustments, but I think the adjustments they'll make is to taxation, not to the base benefit.
Lots of legislation, risk, man. And you just talk about if they start to cut a little bit, this younger generation, I'm 48, the younger generation, you have to look out for yourself because more than likely you don't have a pension. If there could be some reduced Social Security benefit, you have to look out for yourself that you're going to be okay when you go into retirement. And one of the things that Becky, Stonewood, and myself here at Caprock, we talk about all the time is looking out for yourself and building a plan that's going to take the IRS out of your pocket as fast as possible. How can I build a tax-free retirement? It's possible. It is 100% possible, but you have to be proactive in how you do it.
Yeah, I mean, it's wild to think like if you had a checking account, you wouldn't have that joint account with someone that could just decide on their own how much money to take out of that account every year. But with the IRS, that's kind of what we have. In our 401ks and IRAs, we have, as you mentioned, Dereck, this silent partner. But it's actually a silent partner that can change its ownership stake at any time. And that's the variability that I think are so important for tax diversification. It is not that IRAs and 401ks are bad. I have IRA money. I've got TSP money. That's like a government 401k. Yep. But the reason I also have Roth accounts and cash value life insurance and all these other tax-free vehicles is because I need some protection against the risk of rising taxes. That if taxes go up in the future, a portion of my retirement approach will still be okay and I can still generate the amount of income that I need.
Yes, ma'am. Yes, ma'am. So I want to jump back into real quick a conversion. We talked a lot about it last week. I want to be a little more specific because we had some questions and people calling in on how do we save money? How do we save money in taxes? And so I'd like to kind of touch and do a broad example of a program we're going to run or an analysis we're going to run. So if we have somebody, for example, that has $1 million, we get them all the time, husband, wife, they've worked hard their whole life, blue collar, they got $1 million of qualified money. Qualified money means we have not paid our taxes yet. At some point, we have to pay the taxes, whether we take out the money and spend it, whether we use it for income, whether we take it in R&Ds, or we pass it down to our children. We're going to pay taxes on that money when we use it. So Becky, on an average, when we run these kind of analysis and someone has $1 million, and I know this is a rough number, but I'm looking at an average person, what kind of savings are we looking at when we're doing the conversion process as of today in a controlled tax environment?
I mean, we see, obviously, as you mentioned, varies a lot on the person, but if we are looking at both tax savings and IRMAA savings, because if you remember, tax-free income, like from a Roth, does not apply towards your IRMAA calculations, we are seeing six-figure tax savings sometimes, hundreds of thousands of dollars that can be saved in taxes over your lifetime in retirement. So if you asked me, savers listening to this radio show, what's the number one most important thing that they have to do right now, this month, this year? It is get one of these tax analyses run for you. And Dereck, I know you guys do this at Caprock day in and day out for savers.
Every client. Yes, ma'am.
Get the analysis run so you have the information to make adjustments. You cannot make an informed decision without information. And on taxes, it's just most of us, we haven't ever been able to quantify the potential retirement tax bill that may be coming our way. And once you see the potential number for that tax bill, and then the tax savings of converting some of those funds, you can start making informed decisions about where you want your assets. And it is really eye-opening.
No, the numbers are mind-blowing. And when we do that, and that's part of one of the softwares that we run when we meet with people is running the Stonewood reports, is they had no idea that these are going to kind of be the taxes they're talking about and how much we can save. Now, this isn't just hey, somebody walks in and this is what we have to do immediately. No, this is a compromise. This is a work in progress. It might take a little time, 3-year, 5-year window, but these are things over time that we want to help our clients. And that's what differentiates Caprock from a lot of other advisors is tax planning is so important. It's not about just the market. It's not just about, hey, let's go do bonds and equities and let's do this split. No, tax planning is such a huge part of what we do. And I cannot thank Becky enough. I met Becky 6 years ago. It was up in Kansas City. And they changed my business. They changed my clients' lives. They've changed my life about how much I learned from them. And Becky, I think I've seen you 4 times since 2019, because if I get a chance to see Becky and Neil when they speak about Stonewood, I'm going to be there. And so I just want to thank you so much for what you brought to my business and our clients.
Oh, I love that. I mean, that is really my passion, is elevating taxes to have the same weight on savers' minds that things like the market do. It's amazing when I'll, talk to savers and they can tell you where the market went, where they think the market might be going, but they don't realize just like a down market can rob you of income, higher taxes rob you of income. So it's really important to be focusing on that. And I'll mention one more thing, because I know we got some questions about this last time. There are a lot of tax-free vehicles to explore. One of the reasons, we've talked a lot about Roths. Roth is probably the best known tax-free vehicle. But I personally am a big believer, and I know, Dereck, you guys are too, that you want to make sure savers have kind of evaluated all the different tax-free options, because different tax-free options help protect against different kinds of changes for the government. And I'll just make a quick plug for one of my favorites, because I know sometimes a lot of people might not know about this. I converted some of my IRA into a Roth. Actually, I didn't convert it. I saved, because I'm young, some of that money in a Roth. I did that because If tax bracket rates go up, my Roth account is not affected. The income I'm going to draw from a Roth in retirement is protected from taxes. And so I felt like that gave me some protection from tax risk, from the risk of rising taxes. Mm-hmm. However, Roth accounts, which are great, they do share something with traditional IRAs, and that's that they're accounts. So when Congress changes the rules on an account, those changes take immediate effect. I wanted a little extra protection against some of the changes that we might see coming from Washington. The changes that aren't just around tax bracket rates, but are around what is taxed, when it's taxed, how it's taxed, who it's taxed for. Because of that, I actually then diversified not just into a Roth, but also into some cash value life insurance. And I love cash value life insurance in this tax-free space because life insurance policies are not accounts. They are contracts. And when Congress changes the rules on a contract, they can apply new rules going forward, but they cannot retroactively apply those rules to contracts that are already in place. So the old contracts are grandfathered in. One of the reasons I feel so passionately that it's important for American savers to work with professionals who understand tax diversification is that we want to make sure that you are not just converting into tax-free vehicles, but really leveraging a variety of potentially, or at least evaluating a variety of tax-free vehicles to make sure that the protection you want is delivered by the vehicle you've chosen. So I just want to tell you, it is worth some time to sit down with Dereck and his team to explore not just tax diversification, but kind of all the options for that tax-free portion of your retirement.
Man, that is a perfect point to end on. I definitely love cash value life insurance when it's the right situation. And here at Caprock, we're independent. We're not tied to any one company, not tied to any one product. We're going to build the best plan for our clients that we possibly can. And sometimes cash value is the right plan and it works out really well in the right situation. So Becky, thank you so much for joining us today, last week. I appreciate your time. You're just so wonderful to talk to. If you have any questions, please reach out to us, 806-749-7870. My email is Dereck@caprockfinancialgroup.com. And this is Caprock Wealth and Wellness, the Caprock Blueprint to a richer, more balanced life. Becky, thank you so much, and I hope you have a wonderful day.
Thanks for letting me spend some time with you this morning.
I hope everybody has a great Saturday. Go enjoy your day, and I wish you the best of luck, and I look forward to talking to everybody next week. Thank y'all.